Hello again. Welcome to the closing bell on the 12th of July for me, around midday. And during the week, we had the US inflation figures, and obviously everyone waiting and hoping for good news there. And looks like we got it. And I think the most interesting thing out of the inflation figures looking pretty good and definitely giving a sense that it's coming off the boil and, we're heading towards rates dropping later in the year. Very interesting to see the price action in the market. So overnight, after the CPI figure, we had the S&P down, but that was more on the back of the big tech stocks. So Nasdaq really hammered, and the Russell 2000, so smaller cap, mid cap stocks, rallied massively. So really a switch out of those hot tech stocks into those lagging stocks that have been really hammered, I guess, compared to what the tech stocks have done. So that's a pretty interesting development, saying, maybe money coming out of, hiding in those tech stocks to say that, as rates fall, things are going to start picking back up again for those smaller companies. And that switch may be something that will be ongoing. So I'm going to have a look at how that looks. The interest rates coming off the boil as well. And I've been saying to you where those 10 years needed to go before I could get bullish on the bonds, and they're sort of resting on the edge. So we'll have a look at that. And, be considering, is interest rate sensitive stocks, is it time to have a go again? I had one false start a few months ago. I think a few of us did. And then inflation took off again, and now it's starting to fall. So I think there's, a lot of things to consider. And looking at our stocks breaking out to new all-time highs, can this rally have some legs? And also gold flying, of course, with inflation coming off the boil and interest rates dropping. So a lot to talk about today. Let's get stuck into it. So I want to start by having a look over to the right here at what went on last night. And you can see that we've got uh, the S&P 500 down nearly 1%. This is an equal weighted index in the US. So that's imagining if you invested the similar amount into each and every stock, not just, a larger amount in the big stocks and a smaller amount in the small stocks. It's saying imagining investing the same amount into each stock. And that shows you, it was up 1.2%, really big move, versus what the NASDAQ did, certainly. So the NASDAQ down over 2%, and the Russell up 4%. So that's a really big change. And of course, the NASDAQ has been outperforming, the Russell by, miles for years. Is this possibly the starting gun to a bit of a shift in sentiment due to really we're getting to that, crunch time for rates that it probably is going to start coming off the boil. I think the market just becoming more confident that that is now going to be the case. So you can see there, NVIDIA down about 6%. So, it's an interesting sort of set of things going on. Also with gold, 24 up above 2,400, that had a big jump overnight, 30, $40. And we also had a big fall in that US dollar as well. And carrying on to those 10 years, you should remember I said well, don't know what's going on there, but on a monthly closing basis, I was saying those 10 years below 4.2%. So we still need to wait for the end of this month, the end of July. If the 10-year is below 4.2%, I will start, getting pretty bullish on the bonds, and maybe they really start falling rapidly just over the next few weeks. I wouldn't be surprised. So that's all things you've got to think about. So let's just have a look at the 2 years, and we'll just bring up a monthly chart on those 2-year bonds in the US and just looking at over the past however many decades. And I think I've got a logarithmic scale on that, which I'll change. Right, there we go. Um, so, it is pretty clear that we move in these cycles and understanding how they're or when the moments are when things shift is important, isn't it? Because it's a rapid move. And what we're saying here is, are we at that inflection point? And if we are, how far down does it go? I don't think we're going all the way back to where we were. If anything, it may come off the ball for a while, but I think ultimately it's not going to go back to zero. But we could be in just for a phase of rallying bonds. And that's an important part of the calculation in looking at stocks and, valuations, property stocks, interest rate sensitive sectors rallying if you've got high bond yields. Dividend yields on your stocks like a Telstra or something, or the banks, they can rally as interest rates fall. So, it's an important part of the jigsaw puzzle, probably the most important part. And it feels like we're at that sort of inflection point. Um, I would say it is, but as I've said to you in the past, looking for that long-term trend shift, the 10-month exponential crossing under the 20 simple. Here we are really with it on the edge. And we've also had already, if we're looking from the highs there, many months ago, we've had an initial wave down, you can see there, right? And that had the monthly sell pivot there, and then another month going down. And then we've just had this last period over the last, few months, which has sort of thrown a spanner in the works and made it all very difficult to work out what's going on because, the rates stayed high for a long time. That's leading to growth coming off the boil, discretionary spending definitely under the pump, cafes starting to fall over, retail certainly feeling the pinch. People not with don't have as much money around. I just got my gas bill in for the last 2 months. It was $850 and nearly fell off my chair. So I'm not going to go out and spend money on an expensive restaurant dinner this month. So, it is affecting things. Um, and it's only a matter of time when you have rates holding at this sort of level for a long time before things break and, then it's a case of rates falling rapidly. And so I'd say that the high of those rates is in, and this is where, when I'm look at these waves and how they sort of move, I could, just as a very quick analysis of that most recent wave, sorry, is to just look at this wave here, just to point out the idea of this recent rise in yields really just going back up into the sell zone of that wave. So to consider it as, the first wave down. You've got a wave down, got a rally back up into the sell zone, and then now here we are for the next wave down. And this is where, breaking back below that level, back below 4%, for example, you're just starting to set up what looks like the beginning of a downtrend in those yields. So, and just to remember, this is a chart of yields, sorry, in those 2-year yields. So that is a 5% yield, and this is, 4.5% yield. So, prices moving inversely on those bonds, yields rising, prices go down. Sorry, yep, prices go down, and of course, yields going down is that the bonds price going up, just to confuse you completely. So major point being that um, for these bonds on a monthly closing basis in the 2 years, you can see there, if I just look at that bar, the low of that coming around 4.6% on the 2 years. So, a monthly close below that level is going to create a monthly sell pivot on those bonds and will also be probably confirming that moving average crossover on the monthly. So it's just sort of setting itself up that this is probably heading in this direction. It may do it in fits and starts, of course, just to throw everyone off the scent, but that is how it is sort of looking. That's how we should be considering, the portfolio adjustments and where the opportunities out there may be. So this is just the 10 years with a similar, setup, looking at that wave we saw. This is the rise in yields that we saw over the last few years, peaking out at around 5% on those 10 years. Just looking at the most recent wave to the upside, this one here, right? And you're looking at the areas. There's your buy zone. There's your sell zone. So you can see that rates over the last few months did rise into that sell zone area and now are turning down again. So as I've been saying, a monthly close below 4.2% in those US 10 years, for me, is a bit of a starting gun, saying, right, we've got this wave here, and then the next wave down. So we could be looking at something like that. And again, if it is going to head down something like this, you've got to be prepared for it to go in fits and starts, the way it does it. But you're sort of sensing that this is what is coming and, waiting again for the trend to actually shift as we've seen here, as we saw here, before you're really expecting the large move to the downside. But things are setting up pretty nicely, and those CPI figures really leading to a sort of a higher conviction that that's what we're looking at. It'll be interesting to see where the 10 years are by the end of July. So that can feed into a weaker US dollar. And you'll see this is the US dollar over the past year and a half or so. And, that gives a sense of the sort of stagnant market, really, we've been in for us. Does this now prepare itself to roll over again? And, falling US dollar leading to possibly rising commodity prices. We saw gold really take off. We're waiting for copper to finish its correction and possibly take off. But, there's no real confirmation yet about how this thing is going to break out. But again, you're looking at a monthly sell pivot as possibly giving a sense that the US dollar is rolling over. So that would be a close below 103 or something. It's pretty close to there now. So that's really a story for another day, a bit of a tricky chart, that one, but I'd be expecting the US dollar to possibly start coming under a bit of pressure as rates come off the boil there. So gold had a quick reaction last night and is now sort of knocking on the door of that all-time high. Does it mean it's really going to take off now? Maybe it could. I mean, everything is set up for it too. Based on just, technically looking at this, it's at all-time highs. It's trending. The long-term trend is up. These sort of monthly bars are marching higher, the key bars that I look at. Um, so really, you can't say anything other than, look, you should be on it and riding it. It's very difficult to buy it up here because, based on the way I look at things, as I said last week, it still can sell off a long way and still look really good. So, it could have a dummy here and end up shaking people out, but still be trending very nicely, doing something like this. Months and months of selling off back to the moving averages, even looking terrible there, but ultimately heading a lot higher. So, that's sort of how it travels when it's trending strongly. So you've just all you can do really is say, let it go. Maybe it does just keep going here. There are periods where it can just really rally strongly and surprise to the upside. So with rates coming off the boil, maybe that's what will let it loose. Central banks certainly scooping up gold. So from a technical standpoint, you're just saying, right, let it go. And, it's got support at that 10-month and a lot of support at the 20. And, it's got to fall a long way to look bearish, that's for sure. So, happy with my gold positioning at the moment. But moving on to the ASX 200, and we basically have been saying, look, it's all looking bullish, and you've got to be positioned for more upside. But I've been saying, a monthly close below 7,500 in that ASX 200 is going to look bad, and it still will look bad uh, in the short term, even if we rally and then turn back down. But while it holds above there, you are saying this can keep trending, can't it? On this monthly basis, it is we've had 4 months of just going nowhere, trying to decide whether it could break away from that old high from 2021. And that's why it's been really touch and go and difficult to be doing too much because you don't want to look back with the market down there and kick yourself for buying the high just before it fell over. It's always our fear, isn't it? But uh, now that it's, this inflation going and it's trying to break out, can we see a bit of a run? I would like to see that. We've had the end of the tax loss selling season, and I guess it's more in that smaller cap, mid cap space because we've had, money going into the banks. I guess, they could, I guess, go pretty well too, with rates coming off the boil and property sort of focused stocks. Looking at those now, they will probably have a bounce today and may carry on. So, I'll be looking in that sort of area for opportunities. But looking at the small cap space, coming to a decision whether the market is trending or about to keel over again is really difficult. You've got to try to remain dubious about what's going on until you get a nice sort of extra confirmation on the whole thing. You can see here with the small ordinaries, if we're just looking at those, long-term trends and considering those and saying, well, they've been pretty good at giving us a sense. We had a long-term trend shift to the upside after a terrible period, you know, uh, at the start of the year. And the question is, is this going to be a short-term break and then it keels back over? Or are we in the early stages of a long-term trend shift? And what I like to see is, a move trying to break away, a retest of the long-term moving averages. And then if it does start to turn up from there, it's like, well, this is away now. Um, so looking at it from right now, we've had a bit of a rally. It's been selling off. There's a bit of selling pressure around, moving back to those long-term moving averages. If it can bounce from there and run, it's like, well, you may as well go with this. And the view being, uh, you know, if it turns down, you've got a pretty clear line in the sand. This thing goes into long-term downtrend, it's run away very quickly. But if it doesn't, you may be in the early stages of, a multi-year. Who knows what could happen? That'd be nice, wouldn't it? But even if it just does something like that and then turns down, you've at least got time to take some money. So, that's sort of how I'd look at this at the moment is end of that tax loss selling season. If we get some positive news, things can pick up. Those mid small cap stocks could find a bit of buying pressure. A bit wary of the consumer discretionary. I think there is slowdowns coming. And you want to keep an eye on it that interest rates aren't going to cause more problems, and we go into recessionary sort of situation, which can happen. But there may just be a bit of a relief rally coming for us, and the setup is certainly there. If we look at the emerging companies, so this is really small cap companies that have really been blasted. I'm sure you've got a few in your bottom drawer that you wish you didn't have, just like me. And still down 20 odd percent from the highs reached a few years ago. So they're sort of the last to rally, I guess. And I think really need interest rates to be coming off the boil to get a bit of speculative money flows coming back in. And long-term trend shift there, wary of that monthly sell pivot from last month, but a lot of that was tax loss selling. And that's where I'm wondering, is that a dummy, which is tax loss selling? And then we're about to see, the retest of the long-term moving averages and then bang, take off. Because even though it can be tricky when those long-term uptrends are happening, you can get multiple month and even here really huge rallies. So we've been in the doldrums for a few years with all this stuff. A lot of it's just absolutely blasted. So it would be nice to see, yeah, break out above there and see this long-term uptrend sort of start to take shape, that it's ready to go. So I'm going to be willing to go with it. But as I said, you've got a pretty quick get out of jail card if things turn back down rapidly. Yeah, you run away and wait for better times. But for now, you're saying with rates falling as they are, that 4.2% level in the 10 years, can it get below there? Can bonds really start to run? And we see those, yeah, property stocks start recovering. And there could be things to be done out there, which I will be doing for members of my services. They should see an uptick in trading. So that's it for now. Let's see whether things can start running. Fingers crossed, and keep an eye on this switch out of the tech stocks and the broadening of the rally, whether that can gather steam. All right, cheers. I'll come back with more next week.